We are about to experience one of the biggest changes in crypto taxation since 2014. So if you're a crypto investor, the reason it's important is that this totally changes everything about how you report your crypto taxes, how you report your gain, the information that the IRS is getting, and the expectations IRS has for you in protecting yourself. So let's dig into some of these items. Congress back in 2021 passed a law requiring broker-dealers to report income to the IRS. Now, this is typically done on a 1099 form, and the IRS has come out with a new one for digital assets or cryptocurrencies, and it's called 1099-DA. The purpose of the 1099-DA is to inform the IRS about income that you have made. This is going to be very tough to transition to this. Let's put this in perspective. If you're a investor in stocks and bonds, you probably work through a exchange or a brokerage like Fidelity or Merrill Lynch, and you buy your stocks there, you sell them there, you trade them. Everything is done on that one platform. If you have a second platform that you're trading on, you're still doing it all on that one platform. You're not trading them between the two platforms, okay? Because everything is all in one place, the brokerage can issue a 1099. It's called a 1099-B, but it's the same idea. What this form reports is every sale that you made in that brokerage for the year. And since you bought those investments at that brokerage, it can report not only how much you sold it for, but how much you bought it for, which allows them then to report how much gain you made. Well, anybody who's done their taxes with a lot of stocks knows that that 1099-B is just, it's really quite wonderful. All the information you need to put on your tax return is right there. And that's really great, and it's simple. That would be nice also if we could do that with digital assets. If you bought and sold everything on Coinbase and you never used a private wallet or a vault, just bought it on one exchange, sold it on that exchange, then you would get a similar form from Coinbase called a 1099-DA. And it would be so simple to do your tax returns because the buy price, the sell price, everything's going to be on there starting in 2026. And that's going to be wonderful. However, as crypto investors, the old adage is not your keys, not your coins. So most people are unwilling to leave their assets on the exchange, a la FTX and many other exchanges that have gone under. And so the desire is to really hold those personally on a private wallet of some sort, unhosted wallet. When you do that, all of a sudden, Coinbase doesn't really know what the purchase price is. It can't make those connections. So this 1099 form will only report the sale prices and no longer and won't have the information to report the buy price. So that's the challenge we're looking at. Now, what makes it difficult for the investor who has multiple wallets, including unhosted wallets, is how do we then calculate how much your gain is? This is going to be very complicated. It's messy, simply very messy. If you want to keep your life simple, buy and sell everything on one exchange and leave it there. Don't move it anywhere else, like Coinbase or Kraken. Just leave it there, and your life from a tax point of view would be very simple. The IRS regulations have also placed a burden on the taxpayer to keep adequate books and records to show crypto transactions. Up until now, the IRS has not really said much about the record-keeping responsibility stated in IRC's tax code section 6001, where the taxpayer must maintain adequate records, which would be physical records, and be able to produce those to the IRS upon request. And the problem is most people don't even keep any records of their crypto trading. They assume at some later date they can go to their exchange and pull off the transaction records. Well, that exchange may not be there. It may not be there when you need it, and many of the exchanges people have used have already gone away. Look at FTX. Look at Celsius and Voyager, and where's Nexo these days? Holes in your records are things that up until now, the IRS has kind of been working with us on in terms of audits, but the law puts the burden on you as a taxpayer to keep adequate books and records. A new thing that's come out with this new broker-dealer regulation is the calculation of cryptos is now no longer being done the way it's done on almost all the other platforms. When you use Coin Tracker, Coin Tracking, Coin Ledger, Token Tax, Zen Ledger, and several others, the default settings are all totally different. And it's a total change, and it's really going to mess up your calculations, and it requires an abrupt shift in how you calculate your gain and tracking your unused basis. To remedy this, the IRS came out with a transition plan safe harbor. And this will involve several steps. The most important step for the transition plan is you have to adopt a written strategy on how you're going to do the transition plan. Now, at CryptoTaxAudit, we do thousands of these clients, and we know the best way to do it. And so we've actually taken the liberty to create a transition plan, a safe harbor plan that you can use. But it's very important that you prove that you adopted this plan before December 31st, 2024. So to make that easy, you can go to our website, CryptoTaxAudit.com/1099, and you can get this plan, and you just give us your name and email address, and we'll give you a documented PDF. We'll keep a copy, and you can give a copy so you have proof that it's a part of your books and records. All right, that's very big, and you have to do that before December 31st. So that's something I really encourage you to do. Otherwise, you will end up paying much more in taxes and experience penalties and interest, according to the IRS. So what this plan does is basically draws a line in the sand in terms of what unused cost basis you have from your prior trading activity. And then as of the beginning of 2025, you start out with those bases assigned to the actual inventory of your coins on your wallets.